Warren Buffett doesn't own Tesla. Ray Dalio doesn't own Nvidia. The Walton family sold Walmart shares for decades. And there's a college endowment manager in Connecticut who turned down Bitcoin at $8, then watched it hit 60,000 and still says he made the right call. You're looking at this thinking they missed out. They're looking at something else entirely. There's a pattern here, and it's not about being right or wrong. It's about a completely different game. Right now, there are two markets. You're in one, they're in the other. Same tickers, same exchanges, different worlds. In your market, stocks go up because people get excited. Products launch, earnings surprise, memes spread. The chart turns green, and dopamine flows, and everyone rushes in before they miss it. This is where fortunes are made in weeks, where 20-somethings retire off GameStop calls, where every dinner party has someone who doubled their money on something you'd never heard of. In their market, none of that matters, because the rich aren't trying to beat the market. They're trying to survive it, and survival has different math. Here's what actually happens when a stock you love goes vertical. Let's say it's a clean energy company. Revenue growing 300%, CEO on every podcast, retail investors piling in. The stock runs from $20 to $200 in 8 months. Your group chat is going insane. Your portfolio's up 40%. Finally, you got in early on something. Then you check institutional ownership. BlackRock reduced their position by 30%. Fidelity trimmed. Yale's endowment exited entirely. They didn't miss the run. They caused it by selling into your enthusiasm. This isn't cynicism, it's structure. When you manage $1 billion, you can't buy stocks the way normal people do. Your order size moves the price. Your entry is public. Your exit takes months, and the moment other institutions see you buying, they front-run you or fade you, because in that world, everyone's watching everyone. So they don't buy hype, they buy complexity, things most people don't understand and won't touch. There's a wealth manager in Geneva who explained it like this: if you have $10,000 and you double it, your life improves. If you have 10 million and you double it, nothing changes except your tax bill. But if you have 10 million and you lose half, you notice, your kids notice, the foundation notices, the estate plan unravels. This creates asymmetric behavior. You need to be right. They need to not be wrong. Look at what they actually own. Boring stocks, utilities that haven't moved in a decade, industrial companies with 60-year dividends, municipal bonds yielding 2%, private credit deals you've never heard of, real assets like timber and farmland and infrastructure that doesn't even have a stock price. They're not trying to get rich. They already are. They're trying to stay rich, which statistically is harder. Because here's the thing nobody talks about. Most wealth doesn't survive 3 generations. 70% of family fortunes are gone by the second generation, 90% by the third. Not because the heirs are idiots, because volatility kills compounding. Let's put numbers on it. You start with $1 million. Year 1, you're up 50%. Year 2, you're down 40%. You're not up 10% net. You're down 4%. The math isn't linear. Losses hurt more than gains help, which means if you're already wealthy, every swing down costs you more than every swing up rewards you. So they flatten the curve, even if it means missing the run. Now here's where it gets strange. The stocks you love, the ones making retail investors rich, those companies survive because institutions avoid them. Think about it. Tesla wouldn't be Tesla if Berkshire Hathaway owned 30% of it in 2015. Buffett would have forced them to stop burning cash. He would have replaced the board. They would have become a boring car company building sedans in Ohio. No gigafactories, no robot taxis, definitely no flamethrowers. GameStop doesn't squeeze if Vanguard decides to hold. AMC doesn't run if BlackRock refuses to lend shares to short sellers. The entire meme stock phenomenon required institutions to step aside. The chaos you profit from is only possible because they're not there, and they know this. There are hedge fund managers who watch these moves with
with genuine respect. They see retail traders pull off squeezes and gamma ramps and coordinated buying that would be illegal if an institution tried it. And they can't participate, not because they don't want to, because the infrastructure won't let them. Their brokers won't fill orders that volatile. Their compliance teams won't allow it. Their investors would sue. So they sit on the sidelines holding dividend aristocrats yielding 3%, watching kids on Reddit turn stimulus checks into 6 figures. But here's what's happening under the surface. Every time a stock disconnects from fundamentals, someone's holding the bag at the end, and it's never the people who got out early. There's this concept called duration risk. It's how sensitive an asset is to changes in the future. High-growth stocks have massive duration risk because all their value lives 10 years out. If anything changes, rates, competition, regulation, the whole thesis collapses. Institutions avoid duration risk like it's radioactive because they've seen it detonate. In 1999, Cisco was the most valuable company on Earth. Everyone knew the internet was the future. The stock traded at 200 times earnings. Fund managers who didn't own it got fired. Then the narrative shifted, not because Cisco failed. They're still huge, but the multiple contracted, and the stock dropped 86% and didn't recover for 15 years. Same thing happened with Nifty 50 stocks in the 70s and Chinese tech in the 20s. The pattern repeats. A sector gets hot, retail floods in, institutions quietly rotate out, then something breaks, a rate hike, a scandal, a competitor, and the sell-off is vicious because there's no institutional bid underneath. You're not trading against other retail investors, you're trading against nothing, and nothing has no mercy. So why do you keep doing it? Because the upside is real. Those Tesla early investors are actually rich. The people who held Nvidia through the AI boom genuinely won. And every example of someone who got out early and missed the rest of the run is a painful reminder that you can be right about the risk and still lose. Institutions don't have that option. They can't explain to a pension fund why they missed a 10-bagger because they were worried about valuations. Their mandate is to preserve and grow in that order. Yours is to grow, period. This creates completely different incentives. You can take a $50,000 position, and if it goes to zero, you recover. You get another job. You rebuild. If a sovereign wealth fund loses $50 billion on a momentum trade, governments fall. So they optimize for the worst case. You optimize for the best case. And both strategies are rational given the constraints. But here's the twist. The system needs both. It needs you to provide liquidity and take risks and chase narratives. And it needs them to provide stability and absorb crashes and keep the infrastructure running. If everyone invested like Buffett, there'd be no price discovery. If everyone invested like retail, there'd be no market at all. Zoom out and the whole thing looks absurd. We have a financial system where the people with the most money are the most risk-averse, and the people with the least money are taking the biggest risks, which makes sense on an individual level, but breaks down when you aggregate it. Because what happens when an entire generation discovers they can make more money trading options than working? When the path to wealth isn't building companies or saving or investing in indexes, but finding the next thing before it runs. You get a market that's increasingly detached from the economy, where stock prices move on sentiment and positioning and gamma exposure instead of earnings and growth, where a tweet can add 30 billion in market cap and a downgrade can erase it by lunch. The rich avoid this not because they don't understand it, because they understand it too well. There's a portfolio manager in Singapore who put it like this: in the short term, markets are a voting machine. In the long term, they're a weighing machine. Retail plays the voting machine. Institutions play the weighing machine. And both are convinced the other side is insane. So who's right depends on your time frame, depends on your goals, depends whether you're trying to build wealth or protect it. But here's the uncomfortable part. The stocks you love, the ones that feel like the future, they might be, or they might be the next Cisco. And the rich have decided they don't need to know which. They'll take their 3% and sleep fine. The question is whether you can afford to do the same.
If this kind of breakdown is useful, this is exactly what the channel does. No hype, no shortcuts, just how the system actually works. Subscribing just means you won't miss the next one.